Welcome. Let's talk about the future of the automotive industry. It's no secret that legacy automakers like GM and Ford are having trouble as EV adoption draws closer. You may have seen headlines where the CEO of Ford admits that he's shocked by the rate at which EV adoption is happening, and that Tesla has crashed. However, renowned money manager Cathie Wood, who has always been loyal to Tesla, recently made a significant shift in her position on legacy automaker GM, which surprised a lot of us following Wood's shift in position toward GM and DM's recent difficulties. Cathie Wood's ARK Investment Management recently made an investment in GM. In this video, we'll be examining how Wood's new role at GM will likely affect industry perceptions for years to come, whether it succeeds or fails. The significance of Wood's prediction, what it implies for the larger auto industry, and how Tesla's recent pricing cuts fit into the image. But before we continue, hit the like and subscribe buttons. Don't forget to turn on the notification bell too. Wood estimates that Tesla's stock might rise to an incredible $3,000 by 2025. This prediction is not only amazing, but it also shows the difficulties that established automakers like GM and Ford may encounter in the years to come as they attempt to compete with the more innovative and younger businesses. This forecast stands in sharp contrast to the more optimistic opinions of other experts, such Morningstar's David Whitney, who recently told Sandy Monroe that he believes GM stock has a fair value of $68. Jim Farley, the CEO of Ford, acknowledged that the business has lagged behind in terms of EVs. In order to navigate the current market trends in China, where digital EVs products are gaining more popularity, with China being the largest market in the world and exporting to countries like the Netherlands and Norway, Farley said he wanted to address Henry Ford's achievement and how Ford won the world by creating an affordable car for everyone. According to Farley, it's critical to understand that success will depend on providing goods at a range of price points rather than just luxury goods from the 1970s. Farley claimed to have seen GM's market share plummet from 60 to almost nothing, while Toyota, who had no market share before, raced to the top by creating the cars that, while Ford believed it could compete in the sedan and hatchback market, the company struggled in Europe and realized its strength lies in the pickup truck industry. With Maverick, they focus on areas where we understand the customer well, ensuring our innovations resonate with them. Farley believes that considering the entire market, not just a limited portion of it, is the winning strategy. Although Farley acknowledged that Ford is presently just slightly behind Tesla in second place with 6.2% of the EV market share, he said Ford should be pleased of its 95 electric advancement. Cathie might not believe Farley and Ford, however, given the unexpected change of events. More than 150,000 shares of General Motors DM have been acquired by ARK Invest Management for its autonomous technology and robotics fund. ARK-Q. With this purchase, Wood's views on established automakers have significantly changed. Previously, she had questioned their capacity to stay up with innovation. This action follows a meeting between Wood's team and General Motors CEO, Mary Barra, to talk about the company's ambitions for electric vehicles, as reported by Yahoo Finance. The choice to invest in GM is significant because it demonstrates that even a well-known stock picker, known for our bets on high-growth technology companies, is recognizing the potential of legacy automakers and the rapidly evolving auto industry. It also shows that GM's efforts in electric vehicles are on the right track. Wood revealed that ARK was considering investing in GM and was keeping an open mind about it. Autonomous vehicles and technology are gaining traction and may prove beneficial in the long run. Wood's investment in GM is encouraging not only for the business but also for the auto industry as a whole. It shows that established automakers can change with the times and still be competitive, particularly in markets for autonomous technologies and electric vehicles. It also emphasizes the possibility of cooperation between more recent, innovative businesses like Tesla and legacy automakers. As the auto industry continues to change, investors will need to keep an open mind and take a variety of factors into consideration when making investment decisions, according to Cathie Wood. The move by ARK Investment Management also serves as a reminder that investing in the stock market is not just about picking winners, but also about being open to new opportunities and changing perspectives. Recent price reductions from Tesla present a challenge for other automakers hoping to stay competitive, rather than a danger to the brand. Wood thinks that Tesla's cost leadership and battery technology are to blame for these price reductions, and that other manufacturers must adopt this technology to stay profitable and competitive. The company will continue to gain market share and expand its reach in addition to the advantages of spreading fixed costs and negotiating better deals with suppliers. These price cuts are not a sign of weakness for Tesla. Rather, they are a strategic move that will likely strengthen its position in the market as other automakers struggle to keep up with its pricing. As Tesla produces more electric vehicles than it can, economies of scale can help the firm obtain a competitive edge in the market. Furthermore, as Tesla increases its production volume, it can invest more in research and development to improve its products and develop new strategies, which can further enhance its competitive advantage and make it harder for other automakers to catch up. By using prices to attract more customers, Tesla can increase its market share. This can lead to more sales volume, which can further allow Tesla to achieve even greater economies of scale and strengthen its position in the market. Cathie Wood's outlook. Some Wall Street experts, however, have a different perspective on Tesla's recent price cuts. They worry that these reductions could harm the company's profit margins and eventually damage the company's brand value. Certain observers contend that Tesla's brand is founded on the idea of exclusivity and elegance, which might be undermined by more affordable models. However, proponents of Tesla contend that the company's cost leadership, battery technology, and economies of scale will allow it to maintain its margins while lowering prices. They also believe that lower prices will allow the company to expand its market share and continue to innovate in the EV space. Yes, it's true that legacy automakers have been slow to adopt new technologies, particularly electric vehicles, which is one reason Cathie believes they're in trouble. Some critics also point out that Tesla's ability to continue lowering prices could be restricted by rising costs in the supply chain or battery production. While many legacy manufacturers have been reluctant to engage in EVs and have instead continued to focus on gas-powered vehicles, Tesla has been a leader in this field, extensively investing in EV technology and manufacturing high-quality, inexpensive electric cars that have garnered favor among consumers. Cars, which puts them at a disadvantage in the quickly changing automotive industry. The complex and capital-intensive nature of the automotive industry is one reason for the slow adoption of new technologies. Legacy automakers may also be reluctant to invest in EVs due to concerns about the high cost of battery technology and the lack of charging infrastructure. However, as consumer demand for EVs continues to grow, legacy automakers are starting to invest more heavily in the EV technology. Many have announced plans to launch new electric models and to phase out gas-powered cars over the coming years. Even though they may still, the fact that legacy automakers are starting to realize how crucial it is to prepare for new technologies in order to remain competitive in the market is another important aspect that Wood feels is causing legacy automakers to confront difficulties. Along with competition from new players, legacy automakers also face regulatory obstacles. New entrants into the market, like Tesla, Rivian, and Lucid Motors, are focused on creating electric vehicles and have drawn significant investment. These companies are upending the established automotive industry and forcing legacy automakers to adapt to the changing market. Governments everywhere are enforcing more stringent emissions laws, which will make it more challenging for automakers to keep generating gas-powered automobiles concurrently. This concludes our video. If you enjoyed it, please hit the like and subscribe buttons. We'll see you in the next video. Regulators are pushing for higher EV investment, which will put more pressure on legacy automakers who have been sluggish to adapt and stay competitive in this changing landscape. Legacy automakers will need to invest heavily in new technologies and adapt their business models to meet the demands of consumers and regulators. This may require significant changes to the supply chain, manufacturing processes, and marketing strategies, but it is essential if they want to stay relevant in the automotive industry.